Welcome back, everyone. Thanks for tuning in season 3, episode 1 of What Are Your Thoughts? So today I wanted to cover a few different topics, and the first one talking about what I deem, and I mentioned this in the intro, is the COVID mindset shift. And speaking about what that is, how it relates to human psychology, investor psychology, and just overall success when it comes to your financial life. So thinking about the news that came out about 4.5 million Americans quit their jobs here in November of 2021. So thinking about that, the media deems it the Great Resignation. And what I've seen amongst my clientele and really just people in general that I talk to is a mindset change. And obviously, as things happen in life, your view of different topics changes for you, maybe specifically or solely. And the one that I wrote about here in this client email that I referenced in the intro was maybe, someone might have had a parent pass away when they were young, and that could influence how they handle their emotions or think about things emotionally, or it could be anything, any topic, that could affect it. But that might be just specific to them. It's rare to have an event where it affects everyone in some way, and it affects everyone's mindset in some way. And COVID did that. So it's really interesting to think about how different mindsets have changed, or how more than one person, or a majority of people maybe, right, are thinking differently now than before COVID times, before February of 2020. So I've seen this shift amongst a lot of people talking about, different questions that I get. And the questions, are generally now thinking about life fulfillment and being happy. And, life is short, let's enjoy it. Where, the classic American mindset I've seen, at least, has been, work, right? When I first started in the industry, it was, if you're the first to the office, you get some brownie points. And, we would send photos to each other of, I'm closing up the office and it's dark out. And it's like, good work, glad that you worked 15 hours today. I think people are shifting, and they're shifting away from the how many hours do you put in to what do you do with those hours that you've put in at work, and how did you make the most of them. And working from home, has changed a lot for a lot of folks. They can do things now during the day. If they're working and they get all their work done, who's to say that they're not able to enjoy the rest of their day? And I talked about this in a really, really early episode about, I think I might have called it a 6-hour work day, or, I think there's a famous thing out there that's like 6-hour work week or something. And I just was thinking about, people that I remember hearing a story about someone that went to their office and they might have been done working at 3:30, and they just pushed the mouse around their computer screen until 5 o'clock because they didn't want to be the first person to go home. And my thought was just, what a waste. So, there's no rule. There might be a corporate rule at certain companies, but there's no general rule where it's like, you have to work X amount of hours, to get your work done. You can absolutely be efficient and get your work done in a fewer than 40-hour work week if that's what you want. However, what I've seen is that people are thinking, you know what? Why would I spend so much time working and maybe at a job or career that's not fulfilling to then have just, no happiness? And so what I've seen is people talking about, hey, how early can I retire? What am I able to live on? How can I make this work and just live on the, minimum amount possible? And maybe work a part-time job instead, that I don't have to take the work home with me. Like it can be, a fairly mindless task oriented job that I can just go to, put a few hours in, put a little money in my pocket and then live off whatever I've saved. And that's a really interesting shift. And part of it is, just the happiness factor, but the other factor is time, and talking about how time is a finite resource. I've talked about this a lot actually on the podcast and just in client meetings too, just about buying your calendar back. Like, what's the real reason you save money? It should be to buy your time back and get more time to do the things that you want to do with the people you want to do whenever you want to do those things. And that's, again, that resource that is a finite resource as far as, time, right? And the ability to do the things you want to do is huge. And that's what I've seen in terms of that shift. And more or less, it's not people being lazy. I had a really, really, really smart client of mine leave his job at a large tech company because it just wasn't fulfilling. And yeah, he was making awesome money, but it just wasn't fulfilling. I remember the email that he sent me, and it's almost like a weight was lifted off his shoulders by talking about it and having me on board with it. And for me, it was like, look, you're really smart and you could work at really anywhere and make a ton of money, but that wasn't what was important to him. He wanted to have a fulfilling life, work on projects that he wanted to work on, and he was a lot happier doing so. And that's just huge, right? I think people are now prioritizing, a less stressful life and checking items off of their bucket list that they otherwise maybe wouldn't have checked off. So that's just a huge mindset shift that I've seen, and I don't know what it's going to do. At some point, there will be some type of bottleneck in the workforce. We've seen it right now in the service industry where, it seems like every service-based business is hiring and no one wants to fill those positions. And so it's really interesting to think about like how that will shift. And I just want to be clear that it's not necessarily, at least what I've seen, it's not necessarily the people are lazy mindset. It's more just let's be happy mindset. And they're not associating their wealth with material wealth. It's it's either social wealth or basically happiness wealth, right? An abundance of happiness. It's like the board game Life, where at the end you get scored based on your money, your knowledge, and how happy you are, right? The little heart symbol. So that's huge. And something to really think about is, if you are not happy and you're not fulfilled in your current career, what can you do to get out of it? There's an old quote that I love, because again, it's easier said than done, right? And the quote is, it's easier to adjust to the hardships of a poor living than it is to adjust to the hardships of making a better one. And that's so true. And however, I think people are like, look, I'd rather get out of my comfort zone and sacrifice, short-term discomfort for long-term comfort in terms of, just having a fulfilled life. So I wanted to, start 2022 with that topic and just thinking about what you can do moving forward. Like, what are some things that you can do and think about to really be happier in life? And if you're not happy, definitely think about those things and prioritize what would give you some fulfillment in life. And again, money is just a resource to do that, and there are ways to be efficient with it so that you can buy time back again to do the things you want to do. So I will leave that topic there, but it's an important one and something that I talked about with my clients in the monthly email. So let's do a shorter topic and look at just the most popular posts of last year and the most popular content and listens that I got. So the top winner was actually combining finances in a relationship, which I thought was really interesting. Again, that was a topic that was brought to me by one of my friends, and it was an awesome topic, and apparently a lot of people liked it. So that was big. Coming in at number 2 was one of the most recent episodes that I had Colin Overway, and we just talked about fee structures. It was a pretty long episode, and it makes sense that episode was up there because it went to his viewership as well. So and we had a lot of good content in there. It was just pretty long, and so if you found value in it, awesome. That was a fun episode to do. Now, coming in at number 3 was season 2, episode 7, talking about federal taxes 101, and then I talked about taxing wealth versus taxing assets or taxing income. So this one, though, I feel like this episode needs to get restated almost every time, especially as we're coming up on tax season. I had one of my buddies who earns a pretty high income call me last week, and he's like, oh my gosh, these percentages don't make sense. They didn't withhold enough. Am I going to have a huge tax bill? And, I had to make the reminder to him of we have a progressive tax system. So not, if you're in the top federal bracket, your first 100,000 of income is not taxed at the highest bracket, So again, it's important, and especially with tax season coming up, it's important to know how that works, the differences between marginal and effective tax rate. So if you want a refresher, go back to that, season 2, episode 7. And then the fourth one, season 2, episode 10, saving versus investing. Another common question that I get from a lot of people is, what's the difference? What's the difference between saving and investing, and what would make sense for me? So if you want a refresher there, season 2, episode 10 was the 4th most listened to episode last year. All right, wrapping up with the bull market and the 10-year, actually 12-year, I don't know, the past 3 years have been, some of the best 3 consecutive years ever in the market, and that's big. That's big time. However, what it's done has, and I'm gonna click and pull things up here as I'm recording this. So for those watching on YouTube, you might see me looking at my screen and things like that. For those listening, you might just hear some clicks. So just FYI. But looking at that, the long bull market in the past few years of what has happened in the market with it, really just, aside from the COVID crash, right, in February 2020, I mean, the market's really just gone straight up. And that's really, that can be psychologically harmful for investors that, they see a 2, 3, 4, 5% correction and they freak out. They're like, oh my gosh, the market, it's tanking, it's going to crash. And what I want to do, and I'll post a link to this in show notes, is talk a little bit about normalcy of market performance and corrections and things like that, where it's just, it's wild, the psychological effects that the market has. And, it's an advisor value add that we make the pitch to clients, like, look, we're going to coach your behavior so that you avoid mistakes when it comes to investing and financial planning. And the investor, and the prospect's always like, I don't really care, because it's intangible, right? It doesn't matter to the prospect. But I can remember calls in the 3rd or 4th week of March of 2020 where people were like, look, let's just go to, I don't want to deal with this. Let's just go to cash. And looking back, obviously, if I would have done that, that would have cost them a ton of money, because the market has rebounded since and, had a stellar year in 2021. So, so I pulled up here on my screen, and I'll post a link to this in show notes, but looking at this, website called Portfolio Visualizer, and it's a free tool that anyone can use. But I looked at the ticker VFINX, which is just a index fund, an S&P 500 Vanguard index fund from September 1976 to December 2021. And there's a tab for drawdowns to look at when that index had drawdowns. And it's really interesting to look at just how many 4, 5, 15%, 7, 10, just all these different drawdowns, 15, 14. It's really interesting. People don't really remember the Christmas correction in 2018 because the market just rebounded so quickly, and also the COVID crash, it rebounded so quickly as well. But the point here is just psychology is so wild with investing, and it's even more wild with trading, right? And without getting down and down a rabbit hole and into the weeds today, there's people that have made a ton of money just, in my opinion, with lucky trades and things like that, and now they aren't as lucky and they're experiencing some tough times. So just looking back through this, different drawdowns and recovery periods and underwater periods and things like that, and it's really interesting. So the biggest drawdown was the 2007 to 2009, which was the mortgage, they call it, mortgage crisis, subprime crisis, etc. But the S&P 500, or this fund, was down 50%, 51%. So in the matter of 1 year and 4 months, and it took 3 years and 6 months of recovery for a total of almost 5 years underwater. The dot-com crash from 2000 to 2002, that underwater period, so the time that the dollars went down, and then the recovery time was about 6 years. And then what it does is it ranks the top 10 drawdown periods. So then the other 8, the underwater period was fewer than 2 years. So this is a really interesting, planning topic for clients that I talk to clients about in retirement is, look, we need to have what I deem a war chest of cash or short-term bonds or things like that. And we're not going to hold 100% stock really ever for a client on the cusp of retirement. And having a few years of income in those cash-like assets really help that underwater period time when your stocks are down, and they help make sure that you don't have to sell at a loss inside of any of your accounts, because you just have that cash or those cash-like assets available. But again, I'll post the link to this. It's really interesting to look at, and then just looking at the annual returns, but just a wild summary here. So this is from September 1976 to December 2021. If you had $1 million in September 1976 and you put it into the Vanguard 500 index fund, this is mind-boggling. At the end of December 2021, your balance would be $62,860,000. And the compound annual growth rate on that is 11.8%. The best year was 37% return. The worst year was actually also negative 37% return. And the maximum drawdown was that 50 to 51% during the 07 to 09 crash in the market. So it's really interesting to just think about, so many different things, compounding. But what I wanted to make the point of was psychology. And, I remember last year people thinking, we kind of got off to a start where we were above 12% return in the S&P 500 early-ish in the year. And I remember just thinking, like, if it returns 0 for the rest of the year, I mean, that's still a better than average year. And it's just wild to me how different mindsets have changed. Now people think a, conservative or safe return is 10%, and that's not true. If you hold the S&P 500 index, over time, and historically it has outperformed, or has gotten that 10% metric, but how many people could handle a 50% drawdown in that same time frame? So it's really interesting to look at. And again, I just wanted to be clear that corrections are normal, right? 5, 6, 10, 13, as far as downturns go in the market. So, and it happens relatively often. I mean, having 3, 5, 8, 7% corrections happens relatively often. So, it's part of, the art and the science. And that's one thing that I have put a lot of time into thinking about. And I'm going to have probably multiple podcast episodes that reference the art and science of financial planning, because there are so many decisions that you have to use art rather than science when it comes to anything with a dollar sign, and we want to make sure that, you gain an edge, right? That's the whole point of hiring a financial planner, is to gain an edge, which I'll have, an episode about that too. You gain an edge on how efficient and optimized you are in your financial plan. So I will go ahead and cut the pod off here. I hope that everything that I've talked about was relevant, and I'll leave a link to the portfolio visualizer backtest analysis that I ran for you to view. But again, thanks so much for 2021. It was an awesome year, and I look forward to connecting with everyone here in 2022. Thanks so much.